Hello, hello, hello. Can you guys hear me? Anyone in the chat, if you can hear me, just let me know. Yes, okay, cool. And how's the picture quality? Is it 1080? Yep, okay, cool. We'll wait for a few more guys to drop by and then we'll... Yeah, this records, Scott. It's automatically recorded and should be available immediately after the live has ended. What's up, Nicholas? Let's get rid of all the drawings. So I see most of my guys, Discord guys, are in here anyway. This is not something, obviously not something new. You guys already know the system well. This is just an introduction to the Flash model and the other model for the rest of the guys on Twitter and on YouTube. Not sure why there would be an echo, Pete. Jerome Paul is on the viewers. Yeah, he is. I have him on speed dial. I'm not sure why I have headsets on because you guys can't talk to me. That's a bit dumb. Barkat Khan, yes I do. So I've been debating with myself on how much of detail to give out here. So if it's your lucky day today, and as things go, you may get some of it, you may get all of it, right? The guys in the Discord definitely get all of it. All of it, all day, every day. What's up, Indran? Right, give it, I think 30 seconds more and then we start. So this won't be any technical analysis as such, and it won't be a question and answer unless the questions pertain to the actual models, and then we can do that at the end. Discord is where it's at, peeps. Yep. Right, are you guys ready for this? Okay, let's begin. So, in my previous YouTube lives or advanced entry model course, we spoke about the change in the state of delivery and basically what that meant, and what I gave you was an early indication of a change in the state of delivery. there are three different types of change in the state of delivery that we are going to talk about. One being the classical change in the state of delivery as per ICT. One being the one I learned from the currency merchant, which is a bit faster and early signs of change in the state of delivery. And finally, there's going to be a change in the state of delivery, which is my hybrid version and more closer to the ICT classical change in the state of delivery. Now, a change in the state of delivery, this is going to be a foundation for you for understanding these models. And we may interchange change in the state of delivery with MSS, right? You guys can still hear me? Everything good? This is simple, yes, and then I'll carry on. I think there's a slight, yes, okay, cool. Right, so the previous change in the state of delivery was basically if we are in bullish order flow, right? And an order block forms in liquidity. So this was part of the advanced entry model course. And when you have a point of interest or a liquidity area, right? Let's say it's here. Let's say it's right here. The early sign or early change in the state of delivery that we used previously was any order blocks forming in liquidity. In this case, it would be this particular up candle right here. When we trade through the low of an up candle that is formed in liquidity, this becomes a change in the state of delivery, right? You'll notice that with bullish order flow, we go up, down, up, down, up, down, up, down, right? But we never close below the lows of down candles right here, which doesn't change the state of delivery as we move up. So this was the first change of state of change in the state of delivery that we used, which was pretty early, where you have an order block forming. Again, you have an order block forming in liquidity. In this case, it's the up candle that closed in liquidity, this being the liquidity area, and then we trade through it. The aggressive folks would then enter on any retracement, stop above the high, target any liquidity pools or points of interest below, right? That's an early change in the state of delivery. It's not what ICT has taught, and that model worked for me for quite a bit. When we talk about ICT change in the state of delivery or classical change in the state of delivery, classical change in the state of delivery would require the series of order blocks to be traded through, right? So for the first one, just a wick through here, through the down candle low on the early CST, that would constitute as a change in the state of delivery. For ICT, when we have a series of candles or order blocks forming, let's take a look right here. We had a down candle print right here and two up candles print right here. For a classical change in the state of delivery, ICT or the classical definition would be we wick through the opening price of that series of order blocks, right? If the order block started right here and we printed these two up candles right here, when this candle wicks through it, the opening price, wicking through the opening price of the series of order blocks would be a classical change in the state of delivery. Now, for me in backtesting, I didn't take too well with the idea of just wicking through, right? So I've taken it a step further, and this has become my number one filter. I want to see a close below the lows of the series of order blocks. And for me to identify a series of order blocks, I'm not interested in the opening price. I'm interested in the furthest wick from when a down candle forms right here. So if this little wick is the lowest wick, lower than this up candle, I'm taking from this down candle low to the furthest up candle high. Could be a down candle high, whatever it is. Wick to wick, the furthest you can take any point after a down candle prints, whether it's the down candle or the up candle, to the highest point, whether it's a down candle or an up candle. This is the series of order blocks that I am interested in, and the furthest wick low is what I want to see getting closed below, right? So number one, for market structure shift or the change in the state of delivery to occur, we want to close below the furthest wick high or low, depending on whether you are bullish or bearish. And until that happens, we do nothing, or I do nothing. These wicks in this example right here, wick 1, wick 2, I do nothing. I do nothing until we get even by a pip, a body close below the lowest level, being this right here, right? That is market structure shift. That is a change in the state of delivery. So this will be how I will talk to you about my hybrid version of the change in the state of delivery, because it doesn't require wicks through the opening price. I want body closes below the lowest level or the highest level of the range of candles that form the order block, right? So let's call it hybrid CSD for now. So that's the number one filter. Number two, this requires two entry models, which I'm going to talk to you about right now. And one you may be familiar with already. It is the most common entry or reversal pattern that you can find, and there are obviously different variations of it. And this is what it looks like, right? This is what it looks like, and I'm sure you guys, you can just say yes in the chat if you have. I'm sure you guys have seen this reversal type of pattern all over Twitter, the internet, wherever it is, right? This is what your eyes should be trained to look for when you are looking for reversals to occur. Now, I'm going to mention the name here only because the next model is going to bounce off of this. And this pattern, albeit I was first aware or alerted of this pattern on Twitter by a guy named Ribs. But the understanding, remember, this is not a pattern, right? It's an understanding. And this understanding, or this particular model right here, taught by the currency merchant, and I'm not going to go into the deeper details of this model, right? I am only going to use this for now as the pattern that we look for, right? But there's a deeper understanding of this fractal, and this model is called Zoom, right? I'm not going to go into the details of this. It's not my job or my place to go into the details of this particular model on a public platform. But for namesake, this is called Zoom, right? This is a Zoom model. Now, when you go and look in your charts, you notice that you are always looking for, let's say, bullish order flow, right? And then we put in a high that forms maybe at a point of interest. We do that. This is where things start to reverse, or where you start to look for reversals. Because remember, as we are going higher and higher and higher in bullish order flow, we are not taking, we may take liquidity internally inside here, but the aim of the game is to keep making new highs, right? This keeps with order flow. And once we start to see the pattern, quote unquote, show up for work, we are then looking for the Zoom model ideally, right? So number one, you're always looking for the Zoom model, and I was always looking for the Zoom model inside here, where you have this leg up here, which is called an opposing liquidity run, and the liquidity or the point of interest can be up here somewhere. And then you have the push away, which is down here. You then get a retracement back into the range, and then you get continuation down, right? The retracement back into the range could be an order block, it could be an FEG, some point of interest. Your understanding of how this works should be that when we took this high right here into the point of interest, this was buy side liquidity run. When we took the low right here, this was sell side liquidity run, thereby creating what we call a dealing range. From this high to this low is now your dealing range. And you would then classically, let's look at this, pull out your fib, look for where 50% is, premium and discount ideas. You would do something like this. You would put a fib onto it, and you would look for any PD arrays at or around the 50% level, generally an FEG or an imbalance, and you would look to fade that with your stops above the high, right? This is how the Zoom model, or the basic version of the Zoom model, works. Now obviously there are variations of the Zoom model, and the variations get a bit more complex, where you have your liquidity run, your Judas, your turtle soup, whatever you want to call it, that runs the low into an area of interest, a point of interest. We have a push away. It could do something like this: create a level of inducement that front runs your FEG or order block right here, move away like this, come back for it, tap your order block or FEG, run any stops that are below here, and then start to move away, right? This one would be them generating liquidity internally, and this particular point would be a level of inducement. This would be your ideal target, which is your order block down here. This is what you wanted. This was a front run, creating inducement. They could even do something like this, then come back down to your order block and then move, right? So this level would be inducement, and then this is just a variation of the Zoom model, right? Now, as I learned the deeper understanding of this and went back into my charts, I was always looking for a Zoom model. Every entry or every reversal pattern that I wanted to trade or take would have me looking for this model right here, or any variation of it, right? Now, that's not always the case. There will be times when price will move away from your level, or a level, or area of interest, and you may be left stranded because you are looking for the Zoom model. But the Zoom model doesn't show up for work. On deeper backtesting and looking into the charts, it was clear to me that there is a second model, which I now call the flash model, because that was I'm a DC fan. I watch the Flash, and if this is Zoom, which is Flash's enemy, then the next model is coined the Flash. So this is the Zoom model, and now we're going to look at the Flash model. And the Flash model basically is price comes down into your area of interest. We move away. We don't run liquidity here like the Zoom model. There's no Judas, there is no turtle soup. We put in a series of down candles in this case, and we close back above them. Now, when you see this, or how many of you have seen this on your charts and not the Zoom model? And you were left looking for an entry because you wanted to see some kind of reversal pattern that looked like this, or some sort of liquidity run, and then price moves away. But it doesn't happen. So the Flash model became a pivotal in my trading as of the last 4 months or so. Because when you understand what happened inside here, that when price moved away right here, we made a higher low in this case, because this is a bullish model. And when price closed above this range right here, it became a market structure shift and a change in the state of delivery, right? MSS. The job in this model is to trade the order blocks like most models. Here we trade the order block or FEG in Zoom. Here we are going to be trading any retracement back into this immediate range of down candles that were made right here. Let's do this rather. This range of down candles right here. Any retracement back into that range is where your entry is going to be. Your stops are then going to be placed below that range. And your next move or your expectation afterward is this, right? Continuation. The flash also comes with its own variation of inducement, where you have a run into the level, a move like this. You may have something like this, right? Here, and then we move away. You may even have something like this, back into the level, and then we move away, right? Just levels of inducement being created or liquidity being engineered right there and right there. But your level to consider is always going to be the range of down candles created. So this is where your market structure shift occurred. And your range is always going to be this level right here. As long as we move away, we create a series of down candles and we close above them. Once we close above them, the lows of this series of down candles should be protected or safe. They can wick through this range. We don't mind it. I allow it. But we should never see closes below these lows right here of this. I'm going to use the term loosely, the order block range, right? While it may not be the most technical definition, I'm not interested in the technical definition of what an order block is here. I'm interested in ranges. And when we talk about ranges, we can't talk about ranges without talking about equilibrium, because consolidation seeks equilibrium. So these two variations of the flash all require or involve mitigation of an order block that was created prior to the high being broken right here. So in this case, once we closed above this, it was market structure shift. We look for retracements back into the range and we look for price to move away. In this case, a little bit more advanced, but the idea is still the same. We want mitigation of this order block right here. And low time frame inside here, you would then be looking for a change in the state of delivery that occurs somewhere here, right? So understand the differences between the two models. One requires a run of liquidity like this, a dealing range to be created, retracement and expansion. The other doesn't run liquidity. This may have run liquidity. This move here creates the market structure shift right there. Your only job is to trade any retracements back into the order block and for price to move away. Does that make sense? Is it clear what the differences are between Zoom and Flash? Because once you understand what I just showed you right now, we are going to go into the two filters that had to be created in order to use both of these, Zoom or Flash. And we are going to change the way you look at dealing ranges in a classical way, where in the Zoom model, this low to this high right here would be your dealing range, and you would be looking for any retracements back into it to go long. the zoom and flash model, or the models that I'm going to teach you now, do not rely on a dealing range to be created. We are only interested in the range of order blocks that formed, and once we close above them, we want retracement back into them. So in the zoom model, it would be this range right here that was created, and once we close above it, I want retracement back into the order block, mitigation, that's the word, the fancy word. And when they don't come back into it, it's called an unmitigated order block. There is a likelihood that at some point later on, they would come back to mitigate it, collect orders, and move away, right? So in the zoom model, it would be the Judas, turtle soup, OLR leg of down candles in this case that have formed. We want retracement back into it, and we want continuation. In the flash model, it is this middle leg created right here that led to the market structure shift. This led to a market structure shift upward right here. This series of down candles led to the market structure shift that occurred up here. Make sense? Yes, no? Because I need to move on to the two filters that were created to specifically use these models. Then we can go into some examples. Are both these clear? Simple yes. I know there's a time delay here. Simple yes. Okay, cool. Now that you are familiar with how the two models look, the names of the models, and what is required of you to trade these models, let's look at filters for these two models. Let's leave this on for now. Filter number one, right? If you identify any series of down candles or an order block range, I'm going to make this red for now. Make this red. Right? Filter number one. When there are no imbalances in the range, right? So when there are no imbalances in the OB range, you trade the opening price, right? That's number one. What does that mean? What does trade the opening price mean if there are no imbalances? Simply, we'll move away for here for now. If this was the model right here, right? And these are the series of down candles that print right here, right? You have a wick on this side, let's call it there. You will have a wick to the low, let's call it here. This range from this high to this wick low here is the entire series of down candles that I am interested in, right? But the opening price of the series of down candles is not the wick high. It's the start of the series of down candles. That is the opening price. The opening price of the range of order blocks that formed. Now, going back to the first filter, when there are no imbalances in the OB range, trade the opening price, right? We'll put it here. And that could simply mean this. You had, let's get rid of this. You are going to need to understand what the candles are doing, right? So you had a series of down, one candle right here. You had another candle print up like this, which is an up candle range. You then had a single candle running the liquidity like this. You then had a change in the state of delivery or something that occurred like this, right? Another single candle that closed above this up candle range high, or the range that was created from this up candle's high to this down candle's low right here. This should be an up candle. Then you can see that it is clear that there are no imbalances in this range on this time frame, because we had a move down, a move up, a move down, and the very next candle created a move up. When you can see, what I just drew is essentially a zoom model. Can you see that? But you are seeing it in the form of candles. That when we close above this level right here, or the furthest wick right here, it creates a change in the state of delivery. You are looking for any retracements back into the range to go long. But the filter, or the number one filter for price action that looks like this, is that if there are no imbalances in this range, you trade the opening price right there. You wait for a change in the state of delivery to occur here, and that's your next move. So you're trading the opening price. Now that is different to filter number 2. Filter number 2, there's only going to be 2 filters for this entire model. When there are imbalances, right? Term imbalances would be FEG, volume imbalance, whatever it is, right? When there are imbalances that you can physically or visibly see, trade the imbalance or equilibrium. These are the only 2 filters that you need. Number 1, when there are no imbalances in the OB range, trade the opening price. Number 2, when there are imbalances, trade the imbalance or the equilibrium. So what that would then mean in this case is we had something like this. We had a wick here, we had a wick here, we had a wick here, right? If you are able to identify that this is an imbalance, FEG, that your job is to trade that imbalance right there. If you are trading this imbalance blindly, your stops for all of these would have to go below the lows. If you want to be safer, you wait for a down candle to print. We take its high, it's a change in the state of delivery, retracement, you trade it as an order block, expansion. Because remember, any down candles printing inside an FEG, once we take the high of that down candle, that gets validated as an order block. Down candles printing inside an FEG, we like. CSD, retracement, expansion. Right? Is this clear? When there are imbalances in the order block range, you're not going to look to trade the opening price right here. No. You're going to trade the imbalance, or you're going to trade equilibrium. Does that make sense? There are only 2 filters that you require to understand for all of this to work out for you. Only 2. Make sense? Number 1, when there are no imbalances in the OB range, trade the opening price of that OB range. Number 2, when there are imbalances, trade those imbalances or the equilibrium of that OB range. Makes sense? Is this simple enough so far? You haven't seen me complicate or talk about anything fancy that you guys may not already know. Yes? No? I've stripped away every single fancy concept that I could possibly use. I can get highly complex or complicated when using these models. My guys in the Discord know. You can talk about dealing range logic. You can talk about high probability failure swings, FEG hacks, inverse FEGs. You can talk about all of those things. But I'm not talking about any of those. This is the only two models that I want you to fully understand. One being Zoom, and the second being its counterpart, Flash. Understand what is the OB range that we are looking to trade. Understand that when you are able to identify the OB range, you then look back to your filters. Number one, if there are no imbalances in that OB range, trade the opening price. Number two, when there are imbalances, trade equilibrium. But first and foremost, trade the imbalance. Trade the imbalance, then look to trade equilibrium. Right? Yes. Does that make sense? Is everything in order? Can I move on to the next step of this? Is that a yes? I'm not sure what the time delay on this stream actually is. It could be seconds, it could be a minute, I'm not sure. All good, right. Let's move on to one more thing that I've already touched on. Imagine clicking. Let's look at one more thing that I haven't touched on before we move on to live examples, right? And that requires the simple understanding of how structure works. Remember that there's structure within structure within structure, and these are all fractal. Because when you understand that if price is doing something like this, right? That within this may be an M5 or M15 range of candles. But within this, what are you seeing? Aren't you seeing things like this? Yes? No? This is what you are actually seeing low time frame. Right? But high time frame, all I want you to understand is that all of this is noise. You are only interested in a swing point that's put here, 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 here. That's all that you are interested in. Everything in between is noise. Now, when order flow is bullish, we'll get to the point of interest, right? When order flow is bullish, we saw something like this occur on the low time frame. We then push up. We mitigate an order block inside here. We then start to push up. We come back. Once we close above here, we come back to mitigate, and we move up. We come back to mitigate until that point of interest is met. Could be right there. What do you notice inside here? That every time we created a range high, like this, and we closed above that range high, that the lows of those range highs become what we would like to call order block ranges, but also the lows of those highs become protected. They will never go below the lows of those highs if they have been mitigated, an order block has been mitigated, and we create a new high. They should never go below the lows of these highs. All of these should be protected. It is only in extreme cases that you get an example like this, right? This is where the noise part comes in, because structurally everything here is good until this point right here. Notice how after we closed above a high like this, we never, after the important thing, we close above the high, we didn't come back to mitigate equilibrium or any imbalances or anything inside here. What does that mean? It means it leaves this range that we just created, it leaves it open for price action to do something like this and still be bullish afterward. It is only when the protected lows are taken out that you are going to get bearish. How often have you seen them run price up like this, create the trend line liquidity, and then one foul swoop, come back into an OB and then move away, still be bullish? Yet you would now think it's bearish, and every chance you get, you'd be shorting. You'd be shorting. You'd be shorting. And they would just be keeping driving price higher until they make a new high right here. How many of you are guilty of that? We're all guilty of that. No one can tell me that they aren't. No one can tell me that they aren't. So you inverse this for bearish order flow. But remember, the lows of down candles, and more specifically, what we are going to look at is this, right? When the market structure shift occurred, it happened right here. Market structure shift, CSD, all of that happened right there. When that happened, we identify the order block range right here from this candle's high, the highest in this range, to the lowest. Now I alternate between wick to wick and body to body, and the only time I would use body to body is if the wicks on these ranges below here are far too big. I don't want this range to be this high or this big. I don't. I would prefer to use body to body where the actual volume or data is, than use wick to wick. But if the wicks are tiny, like this, it's negligible to me to use wick to wick. Make sense? So if this is the first order block range created, we close above. I want to see mitigation back into that range, either the FEG, opening price, 50%, at least 50% of this being mitigated. Because this also becomes a problem when they don't, like something like this. How often do you see this, and this all comes back down to these being a magnet for price? 50% of this order block comes back and gets mitigated right there. It happens. You must have seen it. So when they don't mitigate and they still move, it's fine. As long as they create a new range and that range gets validated once we close above it, I'm not worried or interested that they come back inside here right now. My concentration is on the immediate range that was created, that we should mitigate that range, break above it, create a new range like this, and keep doing so. We close above it, we come back, we mitigate it, we close above it, we create a new range right there. We close above it, we mitigate, and we move. That's all that I'm interested in. I'm wary of the fact that this original range was not mitigated, but I'm also cognizant of the fact that once the order flow starts to get momentum, they will be in a hurry to meet an objective up here somewhere. They don't have the time to come all the way back down here, do something here, and then start moving away. No, let them create a range, let them close above it, let them mitigate and move away, create a new range, and so on and so forth. Does that make sense? Because what I'm about to show you is not only an entry model, it is a continuation model. I am explaining it to you and showing it to you as an entry model in terms of flash or in terms of zoom. But when you are away from extreme ends of a range and price is already reversed, how many of you are left twiddling your thumbs trying to figure out where to get back into the order flow, where to enter and continue until an objective has been met? And the best tool that I could use is a Dexter fib, because if we are able to identify a liquidity run, a Judas, a turtle soup, or an OLR, we can fib that leg like this and target 2 to 2.5 standard deviations of that range. So this is not only an entry model, this is a continuation model to get you in 2 moves or allow you to pyramid at each of these points as price starts to move away until the objective has been met. It could be an FEG up here somewhere, right? It could be an FEG there. It could be an order block. It could be, if you're looking for reversals or buy side liquidity in this case, it could be some sort of high here. Whatever it is. Does the logic behind this make sense now? Mitigation of order blocks and continuation together with order flow? Yes, no? Because we're going to start looking into examples and then that'll be it. Yes, no? Yes, okay. Let's start looking at actual examples. In fact, let's keep this guy somewhere here. Let's keep this guy somewhere here. Get rid of all of the rest. Right. Go into any chart, any price, any time. And we're going to show you, yes, Ben Meta, this will be uploaded at the end of the stream. Go into any piece of price action you can find. It doesn't have to be cherry picked. It doesn't have to be anything in hindsight. Just go into any piece of price action, right? We'll try and find something right here. Right. Let's look at this. This looks like some piece of price action happened right here, right? And in fact, this is a bad example because it's one of the models that I'm not going to show you right now. So we'll skip this one. Sorry, we'll skip that one. Let's look at something here, right? Because this will have a mixture of the models, right? What do you see occurring up here? Price is in bullish order flow. Until when? Until we start going below the lows of down candle lows. That occurs right there. Let's zoom into this. A down candle was printed. We created this series of order block. Well, we can't call it order blocks yet because it's not validated. We created this series of up candles. We then closed below that down candle low right here. Remember, this is the first number one filter of mine. We should close below the lowest low here in the series of up candles. Once you see this occur, your only job is to do this. Body to body of the series of up candles that we closed below, you apply the filter that I've taught you. That filter being, number one, if there are imbalances in this range, trade the imbalance or EQ. If there are no imbalances in the range, trade the opening price. In this case, on this time frame, and you could narrow it down to an M1 if you wanted. You could even use the system on an M1, and we'll go take a look at it. That if you are able to identify that this is what occurred, is this not something you are familiar with? What happened next? Did that not happen next? Did this not happen next? Is this not the zoom model that occurred inside here? We had a down candle, up candles. We had a down candle, put in a swing point. We had an opposing liquidity run, a Judas, a turtle soup. We then proceeded to close below this failure swing low. We then retraced, and then we had expansion. Look, is this not this? All I'm interested in is what was the last series of up candles that was created before we changed the state of delivery or change or market structure shifted. It was this. I could take wick to wick. The furthest wick would be the start of this down, the end of this down candle to the end of this up candle. This is wick to wick. This is the range. I could trade any imbalances inside here. In this case, if there are no imbalances, I'm trading the opening price. This is all you have to do. Even if I traded the opening price right there and my stop goes above the high, if I put a Dexter fib onto this, from the liquidity run high to the low, this can be my trade. Right there. This is a 2.1 on this particular one. But it's money. It's money. Don't worry about how many points this is moving. You're going to be able to do this multiple times in a day. Let's go on to the next part of what occurred here. When we closed below this range and created that initial market structure shift right here, we then retraced to mitigate 50% of this order block. This low right here becomes a mile marker for me. Because once we close below this low, and if you look very carefully inside here, we just did that. I am now looking for any retracements back into the range to short, because what you are seeing here is now becoming a flash model, because we did this, we did this, we closed below the range. I'm now looking for retracement and expansion, and the retracement is going to be back into this order block right here. If you wanted to be more specific, there could be an order block within this range that led to the actual break-in structure here. We could then refine it to just that. Now take what I showed you here and apply it right here. You are seeing this move down, this move up, this broke through this low. Is it not this? Is it not what I just showed you here? What is your job? Identify the order block range. In this case, it would be this body right here to this right here. Look for retracements back into the range. In this range between this point right here and this low of the range right here, are there any imbalances? If there are, yes there are, right here. Trade the imbalance. And I told you, if there is another smaller order block within that before the actual low was broken right here, you could then refine your entries to this right there. Get rid of this, do this, look at 50%. Remember, we can allow them to wick through the range. Your stop will go above here, and your target will still be the same target that you had when you projected with the Dexter fib right here. Right? Same target. Look what happens next. Because within all of this smaller time frame work, is this not simply this move right here? Is this not a flash setup where we created this series of up candles on order block? We then closed below its low. Your job is to trade any retracements back into it if the expectation is that it should break back below this low. This is now the flash model right here. What do? Body to body, the entire series of up candles in this range right here. Once we close below it, it's a market structure shift again. Retracement back into it. We short. Simple as that. Your next position would then look something like this. You're looking to mitigate 50%. You could put your stop above the high. It's only $11. And you could look to take out this low, or there could be something lower that you are targeting right there. Does that make sense? Breaking down what structure is actually doing. Yes, no? And it's not exclusive to when you're just looking at it like this. Because remember, within the move from up here to down here, you had all of this occurring. You had a move down here, a move up here, we then closed below it. You could enter on any retracements back into this range. You then broke below here. Technically, you could enter on any retracements back into this range, right here. Because order flow is bearish. Look here. When we shift market structure inside here, and that occurs right here. Look at what happened inside right here. We put in a high right here. We put in a low, a lower high, a lower low. Is this not the flash model? The moment we close below there, is that not market structure shift? Your job is to trade any retracements back into this range right there. Let's get rid of this. And again, you apply the filters. If there are imbalances in the range, trade the imbalance. There's an imbalance right here. You could trade that right there. Look at this again now. Once we close below the range, right here, this series of up candles from this low to this high before we closed right here becomes your order block range. You mark it off. Any retracements back into it. Ask yourself the question, are there any imbalances in this range between this high and this low? If your answer is yes, trade the imbalance. Where's that imbalance? Right here. Is this making sense to you? Yes? No? Every time you see continuation, it would most likely be a flash model occurring. And for the flash model to occur, we just need to be able to identify where the market structure shift has occurred, trade retracements back into the range. We break down lower, trade retracements back into the range, and trade lower. An imbalance is basically an FEG, right? An FEG. FEGs are created on one-sided deliveries, like so, where candle number one, and I can see that Saba's been paying attention to me or joining me too much because he's basically saying the same thing I am. Candle number one, candle number two is buy-side delivery, one-sided, meaning there are no down candles inside this range right here. Candle number three, the wick low of candle number three, the wick high of candle number one creates this imbalance. What is this imbalance? This imbalance right here means it is buy side imbalance, sell side inefficiency. There's no down candles inside here. Right? So these, when we talk about imbalances, I'm talking about FEGs specifically. Let's take a look down here. Can you see what happened down here? We move down here. We create a series of up candles. We don't close below here. we create another series of up candles, we then run the low right here. What do we do after we've run this low? We do this. Is this not the zoom model? When we close above there, it becomes a change in the state of delivery or a market structure shift, which means your job is to trade any retracements back into it. And if you can identify the order block range that led to the break or cause of market structure shift, in this case, this candle body right here to all the way down here, this series of down candles from this swing high or swing point to when we run the lows right here, this is the series of candles I'm interested in. When we close above here, because that's the number one filter, when we close above here, it's CSD and market structure shift. What is the job? Are there any imbalances in this range? Yes, there are. There's a huge imbalance right here. You could narrow it down to the top of the dealing range or the OB range high to the bottom of this imbalance. Your job is to trade the imbalance. It could be 50% of that imbalance, IOFED just the beginning of that imbalance, but your stops will be below the lows. Your targets, if you are not sure of where this is going to, would be a Dexter fib, 2 standard deviations. Joe, in my case, I'm using CSD and the MSS as interchangeable because the market structure shift occurs when we close above that swing point, which is also MSS. Forget what all of this is doing inside here. All of this ugliness. You've identified this. Your job is to trade this with your stops below here, and your target was somewhere up here. Make sense? Let's go further and talk about how you play continuations. Because once we broke above this range high, we didn't quite come back into the range right here to mitigate anything, right? So that leaves that open for a later point in time. But when we create another series of down candles right here and we close above its high right there, I am no longer interested right now in price not coming back to this. Why? Because we've created a series of down candles, we've closed above it, order flow seems to be bullish. I am only going to worry about this series of down candles right here. Body to body, we close above it right here with this candle. Your job again is once we close above an order block range, trade any retracements back into it. 2 filters. If there are no imbalances in this range, trade the opening price. Where's the opening price of this? Right here. Make it bigger, make it blue. That's the opening price. Your long idea in this case would be something like this. And you'd be targeting maybe liquidity to the left here or here. Now look what happens up here. There is no visible zoom model on this time frame up here. I could because of my eyes, break this down for you into something completely different, but I'm not going to, because these candles up here actually did something like this, and then they broke through. Meaning what? This was a market structure shift right there, but you are not seeing that, which means I could have traded this retracement into that order block right there with my stop above here and targeted something down here, but you are not seeing that on this time frame. You would see something like this. Price went down, price went up, price went down. Market structure shift happened here. What if all the candles are not down candles in the liquidity run leg? It doesn't matter. I'm not interested in whether they are down candles or up candles. If it ran liquidity below us, there should be some down candles inside. But I'm not interested in, I mean, let's look at it, take an example, right? If this was the series of down candles all the way down here, I don't care if the down candle started right here, but had one or two up candles in the range. I don't care. I care that it started here, it ended here, and the market structure shift happened here. Whatever this entire range is will become my order block or range of price. Remember, I'm using the word order block loosely. Will become my range of price that I'm looking to mitigate before continuation. Make sense? Now, when you see things like this happen, would you still be in a trade like this, thinking that price is going to go higher? You wouldn't, because this has market structure shift right here. You'd be looking to fade any price action inside here. Think about it. Down candle prints here, series of up candles print. We close below its lows. Is it not this? Retracement back into the range. You look to short. This being your range of up candles right here. We can allow them to wick through. They should never close above. Look at this again after this. We do this, we do this, we do this, we do this. Market structure shift occurs right here. Once we close below this range or this range right here, this is the series of order blocks that I'm interested in. What happens right here? You trade it, you short. It's the same thing over and over and over again. Look at it inside here. A series of up candles form. We close below its lows, making this the series of order blocks that are, or the range that I'm interested in. Are there any imbalances in the range? Yes, there are, right here, and there's a tiny volume imbalance right there. See that? Trade the imbalance. When you start to train your eye with these things and you see things like this, after the imbalance was hit, we move down, we create this small range, and we close below it right here. Is this not the flash model? Is this not the range or order block range right here? Is this not where you should be looking to short? We close below a range. You should be looking for retracements back into it. like so. Is this starting to make sense now? It's all the time. It's all over, everywhere, all the time. Go back and backtest what I've shown you now. Have I gone through enough examples for you to figure out what's going on here? It's not difficult. Zoom model, we close below here, makes this the series of up candles that I'm interested in. Are there any imbalances in the range? Trade the imbalance. Yes, there are. At 50%, there's an imbalance right there. Makes this my trade idea. Put a Dexter fib on just for confluence from there to there. Target down here. You want long examples? Sure. I've given you long examples. We'll give you more long examples. Here's messy long examples right here. Because price can get messy. We understand that. If you break down what happened inside here, price moved from up here to down here. We put in this. We then make a higher low. Once we closed above it, right there, is this not the market structure shift of the flash model occurring right here? What is your job? The flash model dictates that once market structure shift occurs, this becomes the range. You trade any retracements back into the range to go long. If market structure shift occurred here, that's the range. You would trade this. See that? It's the same things over and over again all the time. Every time, all the time. Go and look at it. Look here. We move down, we move up, series of down candles, we move up. Is this not the flash model? Has market structure shift not occurred here? If this is the flash model and market structure shift has occurred there, then is this not the series of down candles that I'm looking at to trade? Is this random? Is that random? It's not random. You will see these occur all the time, everywhere. Time frame doesn't matter. You want to see this on the H1, you'll be able to see it. Look right here. Look right here. We put in a high, we put in a low, we put in a lower high, we break or close below the low right here. See this? Is this not market structure shift right here? If this is the flash model, again, I'm being repetitive for your own benefit, then this is the range that I'm looking to trade. Being the flash model, is this not the idea right here? Are there any imbalances in the range? No. Trade opening price. Stops just above the high, not directly above the high. Target. This low to the left. You see it? The time frame doesn't matter. It truly doesn't matter. Look inside here. Continuation. If you've missed, or look here, besides continuation, look at the bottom here. We moved down, we moved up, we moved down, we did this. Is this not the market structure shift right here? Is this not the range of order blocks right there? Are there any imbalances in this range? Yes, there are. Trade the imbalance. There's the range, there's the imbalance, trade the imbalance. Price moves away, we create a new range right here, we close above it right here. Is this not the range that I'm interested in trading from this candle body to that candle body? Once we close above its high, there's its high, we close above it. Any retracements back into the range? Ask yourself the question, are there any imbalances in this range? If the answer is yes, trade the imbalance. You'd be longing right here. Is this making sense? Is it starting to make sense? Look here, same thing. We go high, down, lower high, we close below it, right there. Your job is to trade this low to this high as the flash model. Are there any imbalances in the range? Yes, there are, right there. Trade that. It's the same thing over and over and over again. Is it starting to become easier to see? Because when you truly understand what you are looking for, the time frame does not matter. Time frame doesn't matter. You could do this. Look here. You think I'm messing around with you? Price came here, up candle range, OLR, zoom, right? Market structure shift occurred right there, and CSD. This is the range of candles or the order block I am interested in. Mark it off. Mark it off. Are there any imbalances in this range that you can identify? Tiny one inside here. Let's call all of this the imbalance right here. Trade the imbalance. This is a 15-second time frame. Look what happens next. We create a series of down candles after we break above these highs right here. There's your high right here. We created this range down here. More specifically, we did it like this, and then we broke higher. The moment we closed above this range high here, we are interested in the order blocks or the series of candles that led to the break right there. From this high to this low that led to the break of this candle or range high right here. Your job is to trade any retracements back into it. Are there any imbalances in this range? Yes, there are. All of this. Limited to that. Trade the imbalance. I don't need a daily bias. I don't need time. I don't need a daily bias. I don't even need to know what direction I think it's going. All I need to understand is there any MSS occurring? Give me a trade idea with the Dexter fib. It is what it is until it isn't. It is bullish until it isn't. If you think this is a difficult concept, think again. You will find everything that you need inside right here, and the time frame does not matter. Think about this. What happened above this high? I am not interested in these highs that led to this move down. No. When an OLR occurs, I'm looking back to the left to see what is the most recent up candle I can find. If I can find the top of that up candle and where that up candle started, that becomes a range. But more specifically, the highest high in that range from the bottom to the top, right there, is where I am interested in CSD to occur and MSS. When this closes right here, it's game on. I look back to the range, body to body, this body right here to this body low right here. Ask yourself the question, are there any imbalances in the range? If they are, trade the imbalance. There you go. What do you think about that? What do you say that time frame doesn't matter? What do you say to that? Time frame does not matter. Structure matters. Up, down, up, close below, retracement back in, gone. Remember, how do you know whether a CSD occurred and price is reversing instead of retracing to an order block? Remember, your higher time frame order flow takes preference. If this is your higher time frame order flow, right? Remember, on your lower time frame, this CSD that you are playing right here could just mean it's coming back into this range right here to head lower. That's all that it could mean. Until you start to get, or until you can confidently say that this was the point of interest and price should reverse and go higher here, always stick with current order flow. And if that is bearish in this case, you always think that price is coming back to an order block to continue lower. You are on the right side of the trade if you're on the right side of order flow. I can be, the word is contrarian, and long this up here. I mean, something may happen here, but I'm not thinking the moon is coming or we're going to the moon. No, I'm thinking I can long here, and chances are we mitigate this. Maybe I get a change in the state of delivery here, and then we just continue lower. That's it. I'm not asking you to swing trade something to the moon. No, I'm showing you how you can take 20, 30, 40 points each time. And the time frame does not matter. I told you the time frame doesn't matter. The only thing that matters is what structure is doing. That's all that matters. Go back and look. You will see reversal or you will see continuation. It's all over the show. You wondered how people can trade on a 5-second time frame? This is how they do it. This is how they do it. If I didn't tell you this was a 5-second time frame, you wouldn't care. All you would be interested in is which order block you can use to go higher. Look here. Once we close above the highs, right there, retracement, expansion. Time frame does not matter. There's an example right here. Series of up candles, OLR, we close above the range of the up candles highs, making this the OB range that I'm interested in, right there. Are there any imbalances in the range? Yes, there are, right there. Limited to that. That's your trade, right there. You don't have to identify the OLR, James, because the OLR is only showing up in a zoom model, which is that. Remember, the flash model doesn't have an OLR. The flash model has market structure shift occurring right here. You are trading the OB right there. The key is identifying the CSD. It's an opposing liquidity run. It's a turtle soup. It is a Judas swing. It is a liquidity grab. That is what it is. The key is not the OLR. The key is identifying, after an OLR has taken place, what is the closest series of up candles that happened before the OLR took place. Close above that high, it's game time. Long. Right. So that's been about 1 hour 40 minutes so far. I think I've explained enough for you guys to go back and back test what this actually is. There's not much more I can tell you on the, well, there is a little bit more that we can go into, but that obviously we have to keep something for the Discord. So if there's any questions, ask them now, or we end there. Any questions? Yes, no? Right, so this will be available on YouTube as soon as this ends and uploads. This is available on YouTube. The only thing I ask of you is, once the link is made available on Twitter, that you just like or share. That's it. So, but don't worry, this is automatically recorded by YouTube. They will process and upload it to the channel and be made public. Right. Thank you for your time. My throat's a bit messed up at the moment. But that's it. That was the introduction to the flash model. My two filters and the hybrid change in the state of delivery. Go back, train your eyes, see what I see. It's all over the show. It's everywhere. Right, ending the stream there.